Today, we are considering my legislation, H.R. 6553, the Tailoring and Indexing Enhanced Regulations Act, or the TIER Act. This legislation indexed thresholds for Category 2, 3, and 4 banks to nominal GDP to change the static nature of the thresholds that stifles economic growth. As the economy grows, banks also need to grow to meet the demands of our capital markets, their clients, and funding needs of other financial services companies. However, the current static thresholds impede this growth and limit banks' capacity in our economy. Regulatory tailoring is an important tool. We recognize this in S2155 in a bipartisan bicameral basis. We actually embedded it in statutory law. And it's important because we need to maintain the diversity and strength of our economy, and it's paramount that our financial laws properly account for this. As the economy grows and as inflation rises, the volume of banks' real inflation-adjusted assets grows with the economy, and the nominal value of banks' assets rises with inflation. This means banks' respective asset sizes can increase in nominal terms on paper despite still being the same size relative to the wider economy in real inflation-adjusted terms. This is particularly pronounced in times of high inflation, meaning this phenomenon has especially impacted banks over the last few years as we have witnessed historically high inflationary pressures. To ensure our large banks can support the economy, we must index these thresholds and pass the TIER Act. It's important as we consider indexing, important as we consider tailoring, that we remember that regulation, one-size-fits-all regulation is not appropriate. What is appropriate is that the regulations fit the size, complexity, and risk profile of each institution. And what we don't want in this country is a barbell banking system where you have a few handful small community banks and too big to fail GSIB banks. We need that diversity along the spectrum of bank sizes, and we need each segment of the banking sector to serve each segment of the economy as those different banks serve different aspects of the economy. So regulatory tailoring accommodates that, it accomplishes that. And I do anticipate from some of the critics of this legislation, maybe from our friends on the other side of the aisle, that this is risky. This is a risky idea because we saw what happened with Silicon Valley Bank. On the contrary, this is the precise antidote to what we saw with Silicon Valley Bank. Silicon Valley Bank was largely a product of interest rate mismanagement and supervisory failures. It was not the product of regulatory tailoring. What we don't want to see happen is the regional mid-sized banks so pressured by regulations that they simply cannot exist anymore. And all we have is large, too big to fail banks and small community banks. Regulatory tailoring accommodates that diversity. It provides the common sense relief for those mid-size and regional banks so that they can continue to grow and so that they can continue to serve their customers based on their risk profile. So with that, Mr. Chairman, I urge my colleagues to support this measure, and I yield back.
Gentleman yields back. Who seeks recognition?